Hi folks, this is Sean Hyman, and I want to talk to you today about a simple strategy to day trade in the Forex market. And to day trade, you'll want to be on anything from a 1 to 15-minute chart. I would prefer a 15-minute chart, but a 5-minute chart is okay as well. The longer the time frame you're usually willing to go on, the further back you'll see in time, the more clarity you'll have, and also typically the further the pair will move on that particular time frame, offering you more profit potential per your spread cost. So you want to find something. So I'm on a 15-minute chart here, and I happen to be on Aussie yen. You could pick other pairs, but this is just something that's fairly volatile, and it's on a 15-minute chart. So pick something that's volatile and that moves up and down a lot. If it doesn't move up and down a lot, it's not going to be conducive to day trading because your spread costs, which are the cost between the buy and sell price, is your trading cost. And so you want to be able to overcome that and then some. So if you have a spread cost of 3 pips or 5 pips, you don't want to make 7 pips. I mean, you want to be able to make 10 or 20 pips for sure. And so you want to make sure that your pair that you're trading is volatile enough and conducive to trading. The next thing is you want to trade with the trend. So if the pair is above, let me back up. We want to start by putting a moving average on the chart, a 200 period simple moving average, or SMA. So you just go to where your indicators are, where they are on your charting package. You would choose SMA or simple moving average. It's going to ask you for the number of periods. You put in 200, 200, and then hit enter, and it will automatically plot a moving average on your chart. If the pair is above the moving average, you want to look for buy signal biases. And so you look for the moving average to be heading upward and the pair to be trading above the moving average. If the moving average is heading downward and the pair is trading downward below the average, then you want to look for shorting signals. So this would be the buy signals we would be looking for. Here we would be biased to shorting signals, and then when it crosses back above the average, we would be looking for buy signals again. But we want to get more specific than that. The simple strategy that I want to talk to you today about is when the pair comes from trading below the average to above the average, you go on alert and start looking for the first pullback to the average. So here it crosses the average, comes back and pulls back, and when it bounces off the average, that's when you want to buy. And as it heads higher, you can always move your stops up, you can sell off part of your position, what have you, but you usually want to try to eke as much out of that as you can. And so I'm generally for moving stops up and taking partial profits. And anytime it bounces off of that average, you can buy the bounce off of it. Now, one exception to that is when it goes temporarily below the average, but the average is still in the way moving up, and it happens to come back above it. When it comes back above it, then you buy when it comes back above and heads higher. Here's another example when it goes, because it overshoots sometimes a little bit. So it's still upward trending, but it overshoots the average a little bit, comes back above. As soon as it comes back above it, you buy, and as it starts moving away from your buy price, you can move your stop up to protect against loss, take partial profits, etc. Then when it falls below and it hits the moving average and it bounces downward, that's when you want to have a shorting bias and you short, and you just keep moving your stops until you eventually get stopped out for your profit. And do that when it happens again. So here it overshoots again, or actually for the first time it overshoots and then comes down. When it comes back down through, that's when you would short, and you would be able to move your stop through this whole move here. Right here, the pair moves back above the average, comes up. Here's your first retest of the average, bounces off of it, so you buy, and it heads higher, and you just move your stop up until you eventually get stopped out for a profit, and so forth. So you're looking for buy biases above the average when it's sloped up. You're looking for shorting biases below the average when the price is below the average and the average is pointing down. And you're looking for bounces off the average or when the price comes back through the average. So, and the key is when you really go on alert is when the pair goes from being below the average to above the average for the first time. You be patient. Wait for the pullback to the average and wait to ensure that it bounces off of it. Once it starts to bounce off of it, you can buy and follow it up with stops. And then in the times when it overshoots and goes down below and comes back up, you can buy again because the average is still up and the trend is still up. And same thing for when it goes down below, you want to look for a bounce off of the average to head lower. And if the average is still distinctly headed lower and it overshoots a little bit, because markets aren't perfect, they will overshoot, then you look to sell short when the price comes back through the average and just use stops on your way down. Now, as far as protect your initial protective stops, like for instance, when you're buying here, you can always put your stop below an old low is sufficient. When you're shorting, your first bounce off of that, you can put your stop a little above the old, last old high there as well is sufficient also. So these are ways to, just a simple way, very simple way to day trade the Forex market on the 15-minute chart with the 200 period simple moving average. Thanks so much for watching, and God bless. Bye-bye.